So, Japan's industrial sector really kicked off the year with a bang. We're talking the strongest numbers we've seen in months. But here's the question. Does that tell us the whole story?
Hello, this is Japanese Economic Review Channel. It's so great to have you with us. Today, we're going to unpack the very latest data, fresh from the source. All right, so what we're digging into today is the preliminary report on the Indices of Industrial Production for January 2026. This is our first real snapshot, our first glimpse into how Japan's factories and its whole manufacturing sector started the year. Okay, let's dive right into this. I want to show you the headline numbers. This report really boils down to 4 key metrics, and we're looking at the month-over-month, seasonally adjusted figures for January. First up, we've got production itself. And look at that, a solid 2.2% increase. After a couple of down months, this is a really welcome rebound. It's actually the first increase we've seen in 3 months. And it gets better. Next up are shipments, and they jumped even more impressively, up 3.2%. Just like production, this is the first rise in 3 months. And what does that tell us? It suggests demand for Japanese goods was really strong right out of the gate this year. Okay, so what about inventories? The stock of unsold goods. Well, they barely moved, edging up just 0.1%. Now, that is the second month in a row they've gone up, but it's such a tiny increase, it's almost flat. And this is where it gets really interesting. That brings us to the inventory ratio. It fell by a pretty significant 4.6%. And that, my friends, is a fantastic sign. Why? Because it means shipments grew way, way faster than inventories. Goods were just flying off the shelves, not sitting around in warehouses. But hold on. Just when everything looks rosy, we get this crucial piece of context that kind of changes the whole picture. The official assessment, straight from the report itself, says production is seesawing. So despite all those great numbers, the government's own take is that we're just bouncing up and down. It tells us that, January was a good month, but we're looking at a whole lot of volatility, not some smooth, stable recovery. So that leads to the question, right? What exactly was behind that 2.2% jump? Let's peel back the layers and go inside the numbers to see who the real stars of the show were and which industries kind of lagged behind. So what's really interesting here is that we can pinpoint the specific sectors that powered that 2.2% rise. I mean, the big number is one thing, but the real story, the juicy stuff, is always in the details. It's about which industries are actually driving the change. And here they are, the details. The clear standout, no surprise here for anyone following the industry, was motor vehicles. They surged a whopping 9.1%. That alone was the single biggest engine for this month's growth. We also saw some really solid gains from plastic products and chemicals. But it wasn't all good news. On the flip side, you can see production machinery took a hit, and pulp and paper products dipped a little bit too. Okay, so let's zoom back out for a second and look at the bigger picture. To really get what's going on, you have to look at the flow of things. The relationship between what's being made and what's actually being sold. It's all about supply and demand. And that brings us right back to that inventory ratio we were talking about. Now, for anyone who's not super familiar with this, it's actually a pretty simple but incredibly powerful metric. All it does is measure the amount of inventory, stuff sitting in warehouses, compared to shipments, which is the stuff actually going out the door to customers. And the key thing to remember is a falling ratio is exactly what you want to see. It's a huge green flag that says sales are strong. And this is just a brilliant illustration of why that 4.6% drop is such a big deal. It's a really strong signal of healthy demand in January. Think about it. Shipments are up over 3%, and inventories basically didn't move. That sharp drop in the ratio just confirms it. Demand was robust. Companies were selling things way faster than they were making them. Okay, but just as we're all starting to feel pretty good about things, the report throws a massive curveball. You see, the very same businesses that just reported this great January data, well, they also have to provide a forecast for the next couple months. And let me tell you, the outlook changes dramatically. And the contrast is, well, it's jarring. Look at this. On one side, you have the reality of January, that solid 2.2% growth we just talked about. But then you look at the forecast for February and March, and it's a whole different story. They're predicting a drop of 0.5% in February, and then a much, much sharper fall of 2.6% in March. Ouch. So you have to ask, where's all this weakness supposed to come from? Well, for that projected drop in February, the report points a finger at three main sectors: electronic parts and devices, fabricated metals, and even chemicals. And then March, well, the forecast for March looks even worse, and it's being driven by a different set of industries. We're expecting a really steep drop in machinery and electrical equipment. But here's the real kicker: transport equipment, the hero of January, is projected to fall. That's a complete 180 from the sector that was driving all the growth just a month earlier. So the crucial point here, the whole takeaway, is that we have this big contradiction. The optimism from January's data is completely tempered by this much weaker official outlook. We've got this strong start to the year in the bag, but it's immediately overshadowed by a really pessimistic forecast. And that brings us right back to that official assessment, right? Production is seesawing. So what does this all mean? It leaves us with this one giant question hanging over Japan's entire industrial sector. With these strong January results, but this really weak forecast, are we just looking at a temporary blip? Or is this an early warning sign of a much more fundamental slowdown? That's the billion-dollar question, and you can bet that's what everyone will be watching in the months ahead. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.